You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, how we doing? It's Jonathan Rose and welcome to Masters in Trading Live. Masters in Trading Live, I get on here every day the market's open, share some ideas, go over the market, and once in a while we'll share our trade of the day. Market's getting a little just weird, getting a little kinky. That sounds really weird. What I mean by the market's getting a little kinky, I mean the risk measures in the market. Because we talk about VIX term structure. When you talk about VIX term structure, think of that as the amount of risk in the market. You can look at risk from 1 day, 9 days, 23 days, 30 days, 37 days, 90 days, and each of these different risk measures have their own points. So if the VIX 30 days out is super high, but the 9-day is super low, what does that mean? How can traders interpret that information? Because what's going on right now, I think we've seen about 5 times going back the last 10 years. That's how big of a difference between the VIX 9-day and the VIX. And I'm going to show you once we go to the screen share. But when you see things like this in the market, there's a reason. Why is the risk curve shaped like this? We're going to talk about that. All right, let's go to the slide deck. I think you guys are really going to enjoy this one. Okie dokie. So those who can watch the Masters in Trading Live, you'll recognize VIX term structure. On the left here, these are the live prices. Right now, I'll take this over. This is VIX term structure. Okay, many people just watch the VIX. The VIX is a 30-day measure of volatility. When the VIX is low, the market's going to go higher. When the VIX is high, the market's going to go lower. Well, this is the disconnect right now. VIX 9D is trading at 1425 when I took this screenshot. I might be trading at 1450 right now. The VIX for 30 days is trading 19.58, a difference of over $5 or 5%. What does that tell us? Well, common sense. We talk about common sense trading a lot. I'm going to put my common sense hat. There's no risk in these first 9 days of the market. We even have our 100-period moving average. And then our 21-day moving average of just the VIX. Notice the VIX is elevated. The VIX is elevated. But that 9-day measure of vol, nothing going on. Here, look at this chart. It's a different way of looking at it. This is just VIX 9D minus the VIX. Or VIX minus VIX 9D, excuse me. It's the opposite, the other way around. You can see trading at 533. Why is that 533? Well, that's 14 and say 19. That's 5, right? 533, it's a little bit more than that. But look what I did. All the way back to 2013. Now, I know we're walking into an election, but I'm pretty sure we've had some elections in the last 12 years. Look at that right there, guys. That's the difference between the 9 days of risk and 30 days of risk. Last time we got that high, that's COVID. That's post-COVID move right there. That is a huge, huge, huge difference. So now I ask you, how can we interpret this information? What does this information mean to you? Well, here's what it means to me. Anything in the next 20 days as long as these VIX measures stay low, I think any move in the market is complete nonsense, complete BS. I think if the market sells off, it's a buy. I think if the market rallies, it's a sell. I don't think the market is really going to see any significant movement until this VIX 9-day gets its butt off the ground. Because right now, there's just no risk in the market. Okay? So what I want you to do is, if we're buying options, well, obviously October expires this week. If we're buying options, you need a catalyst. Make sure there's earnings involved in your trade. But right now, market most likely going higher before it goes lower, at least in these next 14 days. Here's a trade I was really excited about yesterday. In yesterday's trade movement, I noticed, and here, guys, I'm looking at the NASDAQ futures against the Russell futures. These lines here are volatility bands. So here is higher volatility than here. The wider they go, the more vol there is. This was the trade I was really excited about yesterday at the close. Russell, first time seeing significant strength against the QQQ. Going back, this is October, August, Sept, every month starting from fresh. You can see the Qs underperformed, the Qs outperformed. You can see the Qs underperformed, the Qs outperformed. Well, here, the Qs were outperforming, Russell was underperforming. But there was a big change in the market that happened yesterday. I took this chart. I was excited to share. But look what happened on the opening. NASDAQ straight up on the opening. Russell doesn't move. So this has already been covered. Now they're both selling off. But sometimes when you see a good trade, you got to act on it quickly because it could go away that fast. Again, yesterday's close looks like that. Russell, NASDAQ. This morning, NASDAQ rallies, closes that entire gap. Bonds. Talked about bonds earlier in the week. The bonds, again, this is just implied vol. Volatility is going higher. When volatility goes higher, there's more risk in the market. Well, bonds got right down to their implied vol and they bounced. At the same time they bounced, the stock market sell off. Well, bonds turned back down. Looking at that expected move once again, I would think that bonds bounce as well, that bonds rally from here. Ooh, we got one more for you. I forgot about this. A little metals trade, playing around with charts. I wanted to share this just because common sense trading. Okay? Gold versus silver is the blue line. Gold versus platinum is the pink line. Let's say that a trader wanted to make a bet that these two lines would converge and come back together. How would they do that? Because we're looking for breakdowns in relationships. So if I wanted to sell this blue line, right? I would sell gold, and I would buy silver. If I wanted to buy this pink line, I would buy gold, and then I would sell platinum. Okay? So the trade would be gold, silver, and then gold platinum. If a trader wanted to bet for a retracement, looking at this chart, betting on a replacement, probably a pretty freaking good trade, don't you think? But watch, gold cancels each other out. Short gold, long gold. Long silver, short platinum. We've done analysis already and we're bullish platinum. That makes us so bullish silver. Said this time and time and time again. If we're just going to look at silver versus platinum, and let me tell you, I'm bullish platinum. You buy silver, you would sell platinum to benefit from this chart. I don't like selling platinum. I just like buying silver, guys. Every way I look at it, silver is just inexpensive. Lots of ways to express this opinion. SLV, SIV. We talk about PAS a lot. We have AG as a present holding in our portfolio. Patience. Every way I look at it, we want to be long silver. And when you can't find a reason not to be long silver, it's probably a good do to get your butt long silver. Went through a lot of charts today. I hope it helped. I really just wanted to show you a different way of looking at the market. I like to say a common sense way of looking at the market, or a creative way of looking at the market. For everybody else in our all access, you guys don't go anywhere. We'll be right back.